Welcome to the first video in this beginner's guide series. If you're new to investing or thinking about investing in covered call ETFs for passive income, then this video is for you. With the rise of products using this strategy, there are a lot of first-time investors who are being introduced to covered call ETFs and don't understand how these will perform in respect to their underlying holdings. So hopefully this video will be able to help clear things up and answer all those questions you might have about the strategy. But before we begin, if you enjoy this type of content and want to continue following this series, feel free to like and subscribe to help out the channel. There's going to be a long list of videos coming up, so you don't want to miss out. Okay, let's now get into the details and examples. Starting with the very basics, for those who are just starting their investing journey, an ETF or an exchange-traded fund can be a variety of different things. Primarily, they are usually a basket of stocks that are packaged together to allow investors to gain exposure to multiple assets within a single investment. These can range from tracking specific indexes, sectors, commodities, or even thematic ones, such as a collection of companies focused on AI and cybersecurity. ETFs can also just hold one stock or company, and then by using strategies like covered calls to then become an income-generating product. In some cases, they might not even own the actual stocks themselves, and can replicate the price movement of the stock synthetically by using option strategies. For this video though, we'll just be focusing on the more traditional method, where they actually own the underlying stocks, and we'll leave the synthetic strategy for another time. So overall, an ETF itself can cover a broad spectrum of purposes, but think of it primarily as a wrapper that allows funds to transform and create new products from the underlying stocks. Next, we'll now go over the covered call strategy itself. So to fully grasp how these work, you will have to have an understanding of the covered call strategy that they use. I'll try my best to keep this as simple as possible and stick to the basics for you to understand how it affects the price movements of an ETF. The premise of how these ETFs are able to provide these dividend distributions is by using the underlying stocks, and then writing options contracts where they are then paid a premium. That premium is then distributed to all the shareholders of the ETF every week, month, or quarter, depending on the frequency the fund is decided on. What this does is that they are promising to sell shares at the contract strike price if the underlying stock goes above it when the option expires. If that happens, it means that we will end up losing some of our shares and have to repurchase new ones at a higher price. It also means that we will miss out on any of the gains that are above the contract strike price at expiration. But having to sell the shares is not the end of the world, and is bound to happen eventually with this strategy. But when you hear how the strategy has a limited upside or can be capped, this is what occurs behind the scenes. So the ideal scenario here is for the stock price to stay below the strike price. That way we get to keep our shares and to use them for generating more premium over time. This is why in a strong bull market, if the underlying stock moves up too quickly, it's not the most ideal scenario for the covered call strategy. But keep in mind that can be capped does not mean always will be, and that these funds are actively managed on a daily basis to likely ensure it doesn't happen to the best of their ability. What's also important to know is that the degree of this upside limitation can be mitigated, firstly through the percentage of the portfolio being used to rate options on. Depending on a fund's strategy, they might specify that they only rate options on up to 33% of the portfolio to generate enough premium to meet the distribution. This means that only up to 33% of the portfolio will be used for generating income, leaving the remaining 66% to hold the underlying stock and participate in the gain on the upside. So only 33% of the portfolio faces an upside cap, making it far less of an impact than many people make it out to be. Secondly, all these funds could also employ a modest degree of 25% leverage as well. So this further helps to reduce any upside that could be capped through the increased amount in premiums, and also adds to the overall growth potential of the ETF. Of course, there's no hiding that the leverage will work both ways, so while it can be beneficial in a bull market, it does also amplify some of the downside as well. But because of the premiums being paid from the options, the downside is generally reduced when comparing it to just holding the underlying stock itself. So to a degree, the covered call strategy also provides reduced volatility with the cushion from the premiums that is received. Then thirdly, there are some other ways the funds can strategically reduce the upside limitation through options. This can be done by staggering their contracts depending on the market conditions, or by rolling the options further out before expiration. Some examples would be in the case of earning reports or news releases, where the underlying stock could see more significant volatility in its stock price. This is getting a bit more technical, so before I lose you completely, let's get into some examples with more visuals to hopefully help you the understanding a bit better. So in these next charts, we'll combine most of what I've just mentioned, and are going to be more detailed in nature. These are typically what you would usually see to showcase a strategy when you look it up on individual fund websites. It's a bit complicated to understand by just looking at it as a static image, but I'll slowly go through it step by step and build it up so it's a bit easier to comprehend. Essentially, there are three different scenarios that can happen when using the covered call strategy. Either the stock price stays below the strike price, the stock price rises above the strike price, where the stock price falls below the break-even point. So let's go through each of these scenarios one by one. But before we get into the specifics, we'll start with the chart components and axes so we know what each one represents. On the x-axis, we'll have the stock price, which increases in value going from left to right. Then on the y-axis, we have profit and loss, with the x-axis representing 0 or break-even. Next, we'll start to put on the chart the two lines, one for what happens when you just own the underlying stock, and then the other for what happens when you use the covered call strategy. For just owning the underlying stock, this line is straightforward, where you purchase it at a specific price and then either goes up or down in a linear manner. So if the stock price increases from when you originally purchased it, then the area beneath the line is your profit. Then if it reverses in the other direction where it goes below your purchase price, then the area beneath the x-axis is what you lost. Now let's reset the stock price back to the middle and overlay the lines when a covered call strategy is applied. The first thing we'll talk about is the maximum profit potential. It stops here because that's the point at which the shares have to be sold based on the options contract, and where you stop participating in the upside of the underlying stock. The next part to go over is the yellow highlighted area where the options premium is labeled. This is the premium received for the option, which is then paid out to us as shareholders by the fund. So the parts above the x-axis are profit, and the parts below will be the cushion that reduces the loss on the downside. To see it in action, if the stock price increases dramatically past the strike price on the options contract, what happens here is that it'll be capped by the yellow line. And then anything above it, which we'll highlight in green, would be the profit that is missed out because the shares would have been sold. Now to see what happens in the opposite direction, if the stock price moves down significantly, we would still be in the red as you would if you were to hold the underlying stock. But because of the options premium that is to be paid out, we would be down less when compared to just holding the underlying stock itself. There is actually a break-even point as well, where if the price stays above this, you would still be in the green with profit because of that premium, while the underlying stock would be at a loss and in the red. So again, that is the cushion or downside protection, where you would still get paid as opposed to feeling the full impact of just holding the underlying stock. Okay, now with all the details complete, we'll go over the first example where the stock price stays below the strike price. So to start, we buy a stock at the price of $50. Then we sell a $55 call option where we'll receive a $2 premium. Depending on the contract duration, the price can move up or down throughout the week or month. But as long as the stock stays below $55, we profit by getting to keep the stock and the $2 premium we were paid. So this is the best case scenario for this strategy, because with those shares we can then repeat the same process again to earn even more premium in the future. Now next, we'll go over a second example, where the stock price rises above the strike price. Once again, we start with buying the stock at the price of $50. Then we sell the same $55 call option where we receive the $2 premium. Now if the stock all of a sudden jumps to $60 when the contract expires, we would then have to sell our stock at the $55 strike price. By doing so, we miss out on the additional green area of gains equivalent to $5. So the total profit with the covered call strategy will be the $5 gain from $50 to $55, where it would then be capped, and then the $2 premium that was paid. This would mean the total profit would be $7. Whereas if you were to just own the underlying stock, your total profit would have been $10. Then the final example would be where the stock price falls below the break-even point. So again, we start by buying the stock at the price of $50 and sell the same $55 call option with a $2 premium. This time, the stock price drops below where you bought the stock and also below the break-even point. The contract then expires and we get to keep the stock because it stayed below the strike price. So for both scenarios, we would be holding an unrealized loss of $5. But because of the $2 in premium we received for the covered call strategy, we would then only be at a $3 loss overall. So that should cover all the different scenarios that can theoretically happen. So when understanding the performance of a covered call ETF, it's important to make the distinction that an ETF is not the same as owning a regular stock. There are lots of misconceptions that I feel should be addressed, because they're also important to know and I see them being made quite often. The first is just because an ETF has dropped in price, it must mean that it is cheap and should now be a buy. This is not entirely correct because the price of an ETF moves in relation to its underlying holdings. So if the underlying holdings are currently overvalued, then a small drop in the ETF price doesn't mean it's time to jump in. It depends entirely on the underlying holdings, which could continue to fall until they reach a point where they're more fairly valued before it goes back up again. In the case of a single stock ETF, you'll want to keep track of the underlying company's fundamentals, news, and technical levels, just as if you own the stock directly. For an ETF that holds a basket of companies, or one that replicates the index, you'll want to have an understanding of all the companies or the movements of the index itself. Another misconception is that covered call ETFs will eventually go to zero based on their stock charts because of the distribution payouts, and then the ETF will then close. This is again incorrect, and it goes back to understanding that the ETF depends on the underlying holdings. As long as the underlying holdings stay in business and don't go bankrupt, then the ETF in general will be safe. It's important to remember again that an ETF is just a wrapper and does not work in exactly the same way as a company's stock. If in the case the stock price of an ETF does decline low enough to be delisted, the ETF can then issue a reverse split to bring back up its stock price. Just like a stock split, which reduces the price of a stock, a reverse split does the opposite and increases the price of a stock. This doesn't change anything in terms of the value of your stock, and is just a cosmetic way to adjust the price to remain compliant with regulations of the exchange. A risk that is specific to ETFs though, and could lead to the closure of a fund, would be a lack of assets under management, meaning that there is no interest from investors. And because of the lack of interest, the fund will be unable to cover the expenses of managing the ETF itself, causing a decision to be made to close it. The value of AUM, or assets under management, can be seen on each ETF's page on the fund's website, and is usually updated on a daily basis. There are likely some other misconceptions, but these are some of the main ones I see being made often, and hope this will help clarify some of the understanding around these ETFs. So starting with the first of two examples, we'll look at what happens when there is a red day, where we have multiple ETFs experience a drop in their stock price. Here, we'll be using a snapshot of the dashboard on February 21st, 2025 in our example. This first section is where I group together all the underlying stocks for each of the corresponding harvest ETFs. Then the boxes you see in green and red are the changes to the stock prices on that particular day. The section in the middle here are all the covered call ETFs for the underlying holdings in the section above. So what you want to do when looking at this is compare the two rows to each other in order to gauge performance. We can first start with Microsoft, where we have the underlying stock which saw a drop in price of negative 1.88%. When compared to the covered call version, it also saw a drop in price, but it was slightly lower at negative 1.81%. This is where we see some of the downside cushion at work, where the covered call ETF went down slightly less than the underlying stock. Next is Amazon, and we see that the underlying stock dropped by negative 2.83%, compared to the covered call version, which ended up dropping by negative 3.14%. So in this instance, the covered call version ended up going down more than the underlying stock. This could be due to a number of technical details, but there are some instances that can occur where the covered call ETF version could go down more on a given day. Then for the next one, which is Eli Lilly, this is the only one that was green on the day, going up 0.06%. And this is where we see the opposite behavior of Amazon, which we just talked about, where the covered call ETF went up higher than the underlying stock. Again, this could be due to a number of technical things, but there are also instances like this that can occur as well. So now that we covered a few, let's speed things up a bit for the remaining ones. For Nvidia, it dropped negative 4.08%, while the covered call ETF dropped less with negative 2.32%. Then for MicroStrategy, it dropped negative 7.48%, while the covered call ETF dropped less with negative 6.76%. With Coinbase, it dropped negative 8.27%, while the covered call ETF dropped less with negative 7.39%. For Tesla, it dropped negative 4.68%, which is less than the covered call ETF at negative 4.98%. Likewise for Palantir, it dropped negative 4.59%, which is less than the covered call ETF at negative 5.26%. Then finally for Meta, it dropped negative 1.62%, while the covered call ETF dropped less at negative 1.06%. So as you can see in general, the covered call ETFs do tend to have a slight cushion when it comes to big red days, such as this particular one. Now let's see what happens in this second example, where we see a green day and have multiple ETFs experience a rise in their stock price. Here we'll be using a snapshot of the dashboard on February 26, 2025 in our example. Starting with Microsoft, we see the underlying stock go up 0.46%, while we have the covered call ETF going up more with 0.81%. So we have the covered call ETF rising higher than the underlying stock on this day. Then for Amazon, we have it going up by 0.68%, and then the covered call ETF going up by 1.04%. Next is Eli Lilly, and we have it going up by 1.46%, while the covered call ETF went up by 1.91%. We'll now speed through the rest, but I think you're seeing the trend here, where it is possible for many of these covered call ETFs to actually outperform the underlying stocks. For Nvidia, we have the underlying stock going up by 3.67%, while the covered call ETF went up by 4.39%. Then with MicroStrategy, it went up by 5.09%, with the covered call ETF going up by 5.33%. With Coinbase, it went up by 0.22%, while the covered call ETF went up by 0.68%. Then the only one that is in the red for this day was Tesla, and it went down by negative 3.96%, while the covered call ETF went down less by negative 3.86%. Because it went down less, this is a win for the covered call ETF, likely due to the covered call premium cushioning some of the downside. For Palantir, it went up 1.69%, while the covered call ETF went up even higher with 3.13%. And finally for Meta, it went up 2.46%, while the covered call version went up 3.05%. So as you can see here, it looks like every single covered call ETF on this day beat out the underlying stock itself. This shouldn't be expected all the time, but again, it can happen. So through these examples, we can see that the results can be all over the place, where sometimes the underlying stocks perform better, and then there are times where the covered call ETFs perform better. We'll have to see in the long run how these will continue to perform, but so far these have been quite promising. Keep in mind that these are first and foremost designed to generate income, and any outperformance of the underlying stocks should not be expected. But if in the case it does, then it should be seen as a very welcomed and unexpected bonus. So hopefully with these insights into how the covered call option strategy works, you can get a better idea of how it affects the daily ETF movements. If you still have questions, I'll do my best to answer them in a future video or in the comment section below. Also, if you appreciate this type of content and want help with the channel, feel free to like and subscribe in order to follow the entire series. My goal for the end of the year is 2,000 subscribers, and we're already over 10% of the way there. So thank you in advance, and I'll see you in the next video.